All right. Good evening, ladies and gentlemen. Welcome once more to another interesting webinar hosted by Kamco Invest. Our topic tonight is one that is focused on an asset class that has sparked a lot of interest in recent times with our investors. As an institution that manages an AUM of around 13 billion across various asset classes and jurisdictions, we are constantly identifying areas of the market that fit the interests and objectives of our investors. More importantly, we provide access to such investment opportunities. One such important asset class is venture capital. I'm sure that we are all familiar with the astonishing rise of some of the companies that have taken the headlines by storm with regards to their stellar performance in recent years. Companies such as the FANGs, which include Facebook, Apple, Amazon, Netflix, and Google. Let's not leave out other notable companies such as Tesla and Zoom, all of which are now household names, with some of them being a part of most of our daily lives. Each one of those companies started off at some point as an early stage investment candidate for pioneer and dynamic investors that helped fund their phenomenal growth ahead of others and at the right time. These investors were handsomely rewarded, of course, and are now seeking to replicate the success with the next generation of companies that are able to serve and grow the dynamically changing market, economic, and social landscape. It is quite clear and evident that transformation is constant. It is here and now. There is no better demonstration of transformation than the one experienced through the pandemic. Technology quickly stepped in to fill the gaps in areas of our lives that require us to keep moving in a productive manner. Personally and professionally, technology is not simply isolated as a standalone sector anymore, but rather a driving factor for economies, markets, industries, and companies to continue their growth and remain competitive and functional in an ever-developing world. What we're seeing right here and right now is what we believe is an inflection point that is long overdue. While the outcome of the pandemic was unpredictable, it not only fast-tracked the shift towards digitization, but has become a defining moment for digital transformation. What began as a questionable year for venture capitalists with investments in the startup and innovation ecosystem expected to significantly drop, soon became a transitional point in the venture capital realm, with new opportunities available across various industries. Quarantine and isolation proved to have a positive effect on the technology sector, and hence venture capital activities witnessed a strong return in the third quarter of 2020, with companies lined up to go public. With the potential to generate attractive returns while making a significant positive impact, venture capital has become a critical component of long-term investment strategies. How and why is what we are here to discuss. So without further ado, let's welcome our guest tonight, who will help shed a clear light on VC as an asset class, its merits going forward. More importantly, what and how investors can benefit from VC as a critical part of their overall portfolio allocation. Our first guest is Mr. Jake Zeller, a partner at AngelList, the world's largest platform for startup investing. He's an early investor and advisor in companies including TalkDesk, Mercury, and Bolt.com. Jake is a partner at Spearhead, a program that funds and mentors new angel investors. He is also a founder and general partner of 3.0 Fund, along with Thumbtack's founder, Jonathan Swanson. AngelList is a network for startup success. Their investing platform supports over $2.5 billion in assets under management and 77 unicorns in the portfolio, including Opendoor, Notion, and most notably, Robinhood. Over 50% of all top-tier US VC deals are in the AngelList portfolio. We are also joined by Mr. Fahad Al-Sharif, founder and managing partner of TechInvest. Fahad earned his bachelor's in business administration with a focus on finance before joining the investment banking team at Brown Brothers Harriman on Wall Street at the start of the tech boom. He's well-versed in the technology and finance ecosystems in both MENA and the US, having previously served as group managing director for Sakhar Software. In 2015, Fahad founded TechInvest, an advisory firm that provides opportunities for Middle East investors and sovereign wealth funds, including Mubadala, KIA, and Waha from Bahrain, to obtain exposure to private investment opportunities in both early and growth stage tech in the US. TechInvest has assisted in raising over $600 million and growing. Fahad also seeded several VC funds with a focus on emerging managers. Additionally, he's an advisor and co-investor with notable Silicon leaders such as Jonathan Swanson, founder and chairman of Thumbtack, Reid Hoffman's reInvent Fund, AngelList, the largest marketplace of seed stage investment opportunities in the world, just to name a few. Our third and final guest is Mr. Hassan Sanche, As a dear colleague of mine and head of our private equity department here at Kamco Invest, Hassan enjoys 23 years of experience in private equity and corporate finance. He managed the investment process of various high-profile buyout transactions and advised major financial and strategic companies in the US, Europe, and CIS. But before we start, I would like to note that we will try to cover most of your questions throughout the webinar as they come in. We will also reserve some time at the end for a brief Q&A session, maybe towards the later, if we do not cover all the questions through the material of the webinar. Welcome, gentlemen. Maybe I can ask the first question to my dear colleague. We might be a little bit biased on this one, but I'll just go ahead. Hassan, the first question goes to you. What is VC? And what are the different stages of VC and how do they differ from each other?
First of all, Faisal, thank you very much for hosting this event for us. We really appreciate all the support that you provided to us and enlightening our dear GCC community about what's happening in the venture capital industry. It's a pleasure for us to join this webinar from our side. So let me directly go to the question, which is the definition of VC. I think you choose me to ask the most difficult question, which seems to be the easiest one, because this definition may vary from all the country and and whenever I see a different country, the definitions are always different. But let me start about what is the product group that we are talking about. We are talking about alternative investments. What is the alternative investments? We are talking about venture capital, private equity, hedge funds, real estate. All of these groups can be classified under alternative investments. When you go to the venture capital, the definition classically goes by this. When you have a project or when you initiate a startup, the first money that comes from friends and family. So you have an idea, you go to the market and you say, I have an idea. I want to do this, I want to do that. And the first support for your proof of concept comes from your friends and family. And this group expanded into covering the angel investors. Jake is an expert and I don't want to take the role from him, so I will leave the explanation to this part. But venture capital starts from angel investing, which is from the idea stage to a late stage. This late stage may vary. Why? For example, in Turkey or in GCC, 10 million to 15 million maximum can be classified as VC. But in the US, sometimes even a $250 million third round is under the VC class group. Why? Because the passage through beginning to maturity is generally the journey that we enjoy from the return perspective, from creativity perspective, from technology, from transformation, from innovation. So to make a long story short, venture capital is the classification of an investment class which starts from $0 million, $0.5 million to support your friend's idea, to $250 million to invest in the third round of one of the technology industry companies operating in US or Europe. So we can classify venture capital as a beginning asset class in our league, which is followed by private equity, because generally when a good investment idea comes to the market and supported by the venture capital, the next round goes to the private equity. Then it's generally somewhere in between private equity and after private equity, IPO route also follows. But not to take too much of your time, let me stop there with my definition. So let me leave it back to you, Faisal. Thank you.
Maybe a follow-on question, and you mentioned something that is a journey. And how long is that journey in terms of years? Let's say when you identify a candidate, do you follow it? Do you capitalize on it immediately? How long is that journey from identification to actual investment? So for me, that's a single stage. And then from actual investment to fruition or value creation.
Yes. And this is the second most difficult question, because it depends. I think the easiest answer to this question is the shorter the period, the more successful the investment is. The longer the period, it takes long time. But there's a midway in between as well. The most important thing, Faisal, in investment language is the definition of your need. Because when you come to any of our product group, venture capital, private equity, angel investment, you come with an idea and you put your milestones. As a first milestone, I want to reach that perspective. And to reach that point, I need $5 million. From that point to the next level, I need another $15 million. Then you define your project. Sometimes you define it on your own. Sometimes with your investors, these definitions also changes because we are talking about a very dynamic environment. But I can say that generally speaking, between greenfield, which means the idea stage to the product stage, if we are talking about 3 to 5 years, it's a mature period. Generally, good ideas get rounded very quickly, and 3 to 5 years, it reached to proof of concept level. Then after proof of concept level, we are talking about the growth level, where the idea is approved, the proof of concept is there, capital is there, and you are taking the growth. But sometimes, as we see from the recent companies that we are seeing as well, growth versus some parameters that we get used to might not fly together as well. For example, we are talking about a company that all of us know, Uber, which still has $0 of profitability, but having maybe the 13th or 14th round of investments. So from that perspective, criteria of success, criteria of achievements, criteria of stages, also different from day to day, from year to year. But as of now, I can say that the good investment process means at least the proof of product, the success of the product is in the market in 3 to 5 years, in my own definition, actually. Let me not generalize it.
Now, maybe I could touch up on the stereotypes of the asset class. It's always been deemed risky, maybe for the novice investor or somebody that might not know much about the asset class. And the general rule is that 20% of the assets represent 80% of the gains. Is that the situation with VC today, or was it before and no longer is the same picture? Maybe you could shed a little bit light on the risk of the asset class modern day. I'll leave that question up in the air to whoever wants to answer it.
Let me first start, and I will leave it because I took too much time today. Risk is the word that is risky, because risk, what does risk means? Risk is something that may come out of unknowns, some of your knowns changing in time, but when we are talking about the perspective of any of the asset class that we are talking about, there is a big diligence happening before, during, or after the investment stage. So we are working the best of class industry experts to verify, to proof of concept verification for any idea, say it venture capital or private equity. Then we are utilizing one of the industry leaders that we know, or because when you ask what's your job, 30% of our job is finding good deals, 70% of our job is living in between people, to know the good people, to attract new people, develop new projects, bring the leadership to our companies. That's why, from that perspective, risk from our side means you are taking an opportunity with a calculated ups and downs, then you are managing it accordingly. For me, risk doesn't mean that you bet your money and you lose it. This is not a risk for me. Risk is calculating what are the upsides and downsides and managing it accordingly. If we are talking about that, if you ask me, even buying a house is a risk. When you buy the house, next day, your regional market can fall out and you can lose your 20-30% of the money. And God forbid, maybe tomorrow there's an earthquake and you lose the value of your whole house. From that perspective, the definition of risk change as well. But let me not answer all these questions on my own. So let me leave it to you as well.
How do you increase probability? So risk is the probability of something happening. So what? How, as a manager in the asset class, how do you raise the probabilities of success?
Preparation is the maximum. But Fahad, please continue.
No, sorry. I thought for some reason I thought you were talking to me. Because look, let me start by saying risk in general, okay, is exaggerated when it comes to venture capital. People assume it's the 90s, and people still refer to data that's literally 30 years old. You know, like they say 80% is the loss ratio and 70% is impairment ratio. These are 90s numbers. Today, the average, okay, is about 40% loss ratio. This is the average. So if you work with really good managers and people that know, their performance is much higher than that. And that's a fact. And that's what makes venture capital one of the best performing asset classes, actually, because the risk is getting lower and lower, but the returns are getting higher and higher, right? And that's notable just from all the exits we've seen in the past 2 years, you know, many decade coins coming out of this asset class. So there's a lot more IPOs happening and a lot more, you know, larger markups. And the risk is actually not as much as it used to be, actually much, much, much less. And now it's compared to other asset classes, it's the same. Like it's some.
So maybe we can share the first slide of the presentation that actually shows the comparative returns between venture capital and other asset classes. Most notably, what's in the headlines, like the Dow Jones and the S&P 500. I think if you give us a chance, we'll be pulling up that slide.
Sure. Let's look at that slide, and I can explain why, you know, this is the best asset class. You see here what we're looking at just in the top, you know, clear focus on venture capital, the highest performing asset class. So that statement is backed. If you look at, the table, if you look at the middle where it says 10 years, and you look at the assets, here you have US venture capital in general, the average is about 14.3. Early stage is the highest, it's 15.5. If you go down, you'll see Bloomberg, Dow Jones Industrial Average, NASDAQ, and S&P. They all returned less in 10 years and in 5 years.
For the
And so
benefit of
our
the
fund,
audience, these are annualized numbers. So when we look at these numbers on a 10-year, 15-year, or 20-year basis, these are annualized numbers. So when we look at these numbers, it's quite clear that through multiple market cycles, we've clearly outperformed.
sure, and this is also from last year, right? So I think the public markets did better, but overall in 10 years, venture capital is the best performing asset class. That's the point. And it's data. It's not an opinion. It's not a point of view. It's just clearly the numbers, aggregated over 10 and 15 years. There's also another slide that shows the risk, and let's if Mohammed can put that up. Here, we're just saying what I just said earlier. We're just presenting it here in numbers, whereby the loss ratio and the impairment ratio for VC funds has went down materially. And therefore, it became less of a risky asset class and more of a rewarding asset class. And now, that's one that, so it's really not risky anymore as it used to be. But is there risk? Of course, there's risk. As Hassan was saying, there's risk in every asset class and every investment you do. If you're not careful, you will, you might lose your money. And with venture capital, I mean, it says it right there in the title, right? Here, with increased success rates of investment, loss ratio has been reduced. And if we look at why, I just set those numbers up, so we went down from like 51% in the 90s to 20% of loss ratio. And the same with the impairment, I mean, your losses have been, reduced materially. And this makes it as risky as private equity and other asset classes. But what happened, is, incubators, accelerators came up. They weren't around. Now they're very much part of the ecosystem. Y Combinator. A lot of these companies, Airbnb, DoorDash, came out of Y Combinator. Companies like AngelList, where we're lucky to have Jake with us now. He can touch up on that. Helping angel investors find deals. The founders get better access now to angel investors early, and they all come together and invest via venture funds, small micro VCs of $5 and $10 million that help these startups grow. That wasn't available 2 decades ago. That's happening now. And AngelList today is providing, rolling funds and other ways where people can invest directly in these companies, and that supports the ecosystem and makes better companies, because these are much better investors. They know what they're doing. So good angel investors are your bet. That's why also how you mitigate the risk. And so that's what the slide is saying, is that we do have a strategy on how to mitigate the risk, although the facts show that it is becoming as risky as other asset classes, not riskier. I think these are the 2 points that I think I wanted to add on risk, and I'll leave it up to the other guys to chime in.
I could chime.
And since we're on the focus of the ecosystem, has the modern day ecosystem, VC ecosystem, made it easier to fund these companies, or is it a popular asset class where everybody's getting funded? How does the ecosystem look right now?
It's definitely a popular asset class at the moment. But one part that I think is very interesting is you can't consider the asset class as a whole. It's because different parts of the asset class behave very differently. One analogy that I like to make is thinking about the human body and contextualizing venture capital in the sense of the human body, and thinking about the veins, the capillaries, the arteries. The place of the ecosystem that's the most popular right now is kind of the late stage. And if you think about the late stage in the human body perspective, that's like your biggest arteries in your body. You're able to pump a lot of money and a lot of blood through those because it's able to handle it. And that's where a lot of the money is coming in. And that's also where the valuations are rising the fastest. If you look at the seed stage, the early stage, which is where we recommend investing, That's like the capillaries. These are the tiny little vessels, and it's actually really difficult to get money in there. So it's very hard for, say, the hedge funds, the expansion funds, the people who are trying to write these big checks to even get exposure to the early stage venture asset class. So what happens is, the place where the arteries are, the late stage, that's very popular, and the valuations rise, but the seed stage actually hasn't been as impacted. There's one other interesting point about this. Our data scientist at AngelList did some really interesting math comparing early stage to late stage venture capital. And he actually went even further than that. He looked at the specific stages. He said, let's look at seed, let's look at Series A, let's look at Series B. And he did some interesting data science, and he came up with a radical conclusion, which is that they are actually fundamentally different asset classes. I could dive into why that is if people want to get technical into the data science of it, but it's because the right strategy that works at seed is actually different than the strategy that works at Series A or later stage. And this is why as well, I'm so excited about seed right now, is because every other asset in the world has inflated. Just look over the last 6 months, what's happened across the markets. But
we're going to get to valuations quite soon.
Okay, yeah. Well, everyone has to agree to keep it confidential, because we don't want everyone rushing into it after I tell them the merits of seed.
Well, my next question is to you, Jake. So the focus of this webinar is for U.S. Venture capital, the ecosystem, the U.S. venture capital ecosystem. Why U.S. and how does it compare to the European or the Asian ecosystems that are rising right now? Is it too early for them? Is this why you're focusing on the U.S.? Why Silicon Valley? I think this is what the audience wants to hear.
Yeah, it's a nuanced discussion question. I think when you look at venture capital, you want to focus on where all the returns are happening. And usually what you find is that it's a few outsized examples that drive all the returns. I would much rather be invested in a single DoorDash or a single Uber or Snowflake versus like 100 other startups that end up being irrelevant, because all the returns are concentrated in these few that achieve gigantic scale. And if you take a map of the world and you go and you plot all of these companies, they're predominantly in two places: Silicon Valley or China. China's a different discussion, so I'm going to ignore that for now. And then largely it's in Silicon Valley. And part of why this is because cities have strong network effects. When you're building your company, you want to bring in experienced leaders to help guide your team. You want to hire a VP of sales who's scaled a company before. You want to hire the CTO who's built technology systems at scale before. And predominantly, those people are in Silicon Valley. So that's why the companies have all clustered there, and you have a bit of an industry town. There are interesting outcomes in New York. There are interesting outcomes in LA. But on a numbers basis, it ends up being much smaller. I am certainly interested in other ecosystems, so I'll personally invest in Europe. I'll do some investments in India, but they're much less developed. So I think those are areas to watch, but historically hasn't been as large of a return driver as Silicon Valley.
Fahad, maybe this question is for you. What do you think about the MENA VC ecosystem? Is it something that is flourishing? From what I see, it's just a replication of what's successful in the United States, right? So with Anghami, for instance, like Spotify in the United States. So it's a proven and tested business model over there that's been put into play over here in the region and is quite successful. And you look at the other shopping networks. Is this something that's rising quite significantly and fast? Are you seeing investors here more interested in investing in their regional and local ecosystems, or is there the attraction to invest in Silicon Valley?
Look, every region has certain, attributes that make it good at something or better than others at something. I think what we're really good at in this region is asset allocation. We should stick to investing. We shouldn't stick to figuring out how to fix the next big thing, because we lack two things. Number one, we don't have enough universities, research centers, and coding institutes or computer science institutes to build that workforce that Jake just mentioned, of why cities have that positive network effect that is needed for growth. Okay, number one. Number two, the financial capital markets here are not yet developed to allow for IPOs of companies that have not been profitable. Hassan just used the model of Uber, It's one of the best growing companies and one of the best valuations, but it hasn't turned a profit. Amazon only turned a profit in 2015, and now it's a $2 trillion company. So the point here is the Middle East is very small, and the market is very small. There's only like, 40 million real users on the internet, right? And even that number can be challenged. And so there are Kareem, as you said, Kareem was a $3 billion exit to Uber. That was good. There's Anghami, just went public through a SPAC. That was very good. But then you can count them on hands, right? 5 or 6. It's a great developing market. If you want to do a developing emerging market VC fund, yes, MENA will be one because we have 5G, we have large dissemination we have a lot of good networks, we have multiple like disposable income in several countries in the GCC and other countries. Large countries like Egypt is a big market. We have Saudi Arabia, which is a sleeping giant. Of course, it's a great place to do, but right now we like to focus on immediate growth opportunities. And as Jake was saying, that deal flow, that pipeline is so much bigger coming out of San Francisco. And between Stanford, Caltech, UC Berkeley, just those 3 amazing universities, thousands and tens of thousands of engineers are graduating. Around Stanford, the Sand Hill Road, every single VC is there looking for deals, seeding these companies, as Jake said, right? And then you have every single follow-on stage has the best of practice, has the best VCs on that same road. These are the best Series A guys, the best angel guys, the best late stage guys, etc. So it's tough to replicate that. Boston is struggling with that. New York, London, Berlin, and as Jake said, China is another planet. It's not even on our planet. They have their own little universe. They block all the other apps. They can't go into China, and none of the Chinese apps. How many Chinese apps do you use? None, right? So because you don't, right?
TikTok maybe,
and
one.
But maybe to look for that candidate that is seeking to go global, or you're just fine by identifying a candidate because it's early stage that is successful in the United States.
Well, that's a good question. That's what I was going to add, actually, which is for the venture capital model to work, you need to have really large outcomes. It's possible that you can get a really large outcome in a single country, but to really, really hit it in this asset class, you want to have a gigantic outcome. And that usually means going global and being an internationally dominant player. $1 billion outcome doesn't move the needle in venture capital. That's middle of the road nowadays. You want the $100 billion outcomes. And if you look at the products and the services that we use today, you look at WhatsApp, you look at Instagram, you look at Twitter, you look at Uber, these were started in California and they're globally dominant businesses. Even Uber got a piece of Didi in China. That's crazy. No one thought they were going to be able to do that. So I think that's part of why the venture capital in Silicon Valley is so successful. Not only do they have the resources, but they also have the desire to go and compete and win at a global scale. That's how you do really well.
And as an investor, do you seek that opportunity by, maybe we can drill down a little bit towards processes, if I may.
Yeah.
So do you look at it as a single investor or consortium? How do you come about? Would you rather sell that opportunity to a fund? How do you go about it? Do you prefer a fund as an investor with a collective investment scheme? How do you go about it?
If you're an entrepreneur raising money, was that the question to clarify? Yes.
Yeah.
The advice that I usually give entrepreneurs is, choose the right VC partner, make it based on the individual. And this is actually one of the big trends happening in venture capital now. And we say we're like long the individual and short the firm. So I feel like in this age now where everyone's online, everyone's connected, people are able to build their brand on the internet. Individuals even have stronger brands than their firms. People know Benchmark, but they really know Bill Gurley. And there are a lot of other examples of this. So that's what I tell the entrepreneurs: go and find the people who you think are going to add the most value. And I'd often prefer a great partner at an okay firm to a junior partner at a fantastic firm, because that's the person you're going to be interacting with at the end of the day.
How difficult is it to find an investment that ticks all the boxes? Or do all the boxes need to be ticked before you make an investment?
There's Naval, the founder of Angels, has a great quote, which is every great investment has one fatal flaw. So there's no rules in venture capital is about knowing when to break the rules, but you could come up with a certain number of things that you look for. But what you'll typically find is that with the investments that are the greatest, there's going to be one thing that's a little off about it. Like if you look at Uber, for example, when they raised their seed round, neither Travis nor Garrett were full-time. The CEO is this guy, Ryan Graves. And one of the most obvious rules in venture capital that we tell people is you need full-time founders. They need to be focused and they need to be devoted. So you want to check most of the boxes, and there are certain things you probably shouldn't compromise on, but oftentimes the best deals will look a little bit weird at the earliest stages.
Maybe you can let the audience know, how difficult is it to invest with a top performing venture capital firm? Is it something that is a privilege, or is it something that's available to others?
So it depends how you define it. And I think one thing that you need to be, probably the most important thing that you do in this asset class is make sure that you're not getting adversely selected. And adverse selection means you're not doing the wrong deals, because it's the right deals that make all the money. And what you'll see is that, if you're, say, just trying to co-invest or even just invest with a firm as an LP in their fund, you could go alongside name brands, but often you're not getting the right stuff. So maybe a brand name firm is going to give you an opportunity to invest in their fund, but you're not in their core fund. You're in their growth fund or their secondary fund, which is generally going to have lower returns. Similarly, maybe they're going to give you an opportunity to invest alongside them in a deal, but it's not the right deal. It's the company that's struggling to raise money that they're trying to bridge to the next level success. When a top firm like Sequoia likes a company, they try and box everyone out and get as much ownership in the round as possible. So it's inordinately difficult, especially for people who are not in Silicon Valley, to get access to the best opportunities alongside the best firms.
And how important is a network in Silicon Valley? Is it something that you can never do without? Can you rely on a database to source opportunities, or is it more of a face-to-face kind of a situation?
Network's everything at the early stage. As you go later and later, it becomes more about databases and spreadsheets. But at the earliest stage, it's all based on that personal connection. There's a great quote from one of my former colleagues where he said, everyone in venture capital thinks that the people who invest before them are dart throwing monkeys, and the people who invest after them are like spreadsheet jockeys. But at the early stage, it's all about the relationships.
And I'd like to ask a few questions that I've actually got online here. So one coming from Mahmoud Galal: how did the recent rise of special purpose acquisition companies / vehicles impact the VC ecosystem? Does it help the industry, or would it be another disruption tool to the market?
Do you want to talk about SPACs? I'm happy to share my opinion, which might be unpopular. I'll say something positive, and then I'll say something negative.
Go ahead, rock the boat. It's fine.
Yeah. The positive thing that I'll say is that they play a value, or they serve value right now. Because if you're a founder of a company right now and you're thinking about going public, something that's really important is certainty. Right, we just had a global pandemic. There may be a lot of turbulence in the markets coming up. Who knows what's going to happen with policy, inflation? There's a lot of concern. So if a SPAC's able to help you take a process that might be long and drawn out for going public and compress it, give you certainty, give you speed of going public, lock in the valuation, that could be the right thing to do. However, I'm not as bullish on them long term. I think the clearest sign of bubbly activity in that market is looking at the quality of the sponsors of these SPACs. I wouldn't trust some of these people to borrow one of my video games, let alone take a company public. So it's definitely slightly concerning there.
All right. Now, maybe a question of my own. Will you hold an investment from an early stage? As Hassan said, 0 stage, all the way to IPO. Have you done that before? Do you consider doing that with each and every investment, Warren Buffett style, where he invests in stock and not ever let it go? Is that your approach?
Absolutely. So my view on this, and there's a lot of historical anecdotes I could give, is when people are trying to buy your stock, it's a sign that you don't want to sell. There may be some legal implications with this, but I'll say it. You only sell your stock if you know the company's about to tank and you're the only one who knows that. And what you'll find is when you own a portfolio of private companies, these aren't necessarily the most liquid in the world. You're consistently getting offers on your best performing companies, and you're never getting offers on your dogs. And oftentimes the people who are making offers know more than you. So maybe a company is valued at 3 billion, people will be making offers, hey, I'll buy your shares at 3 billion, I just say no. And then 2 days later, it gets marked up to 6. And I was like, whoa, hold on a second. Is it just pure coincidence that people out of the blue started offering me 3 when, you know, a few days later it's going to get marked up to 6? No, they knew that a round was happening and they're trying to be vultures and take shares from people who were in early. So the advice that I typically give early stage managers is you hold on. The only time that you'll sell is if you sell a small portion of your position and it can have a very meaningful impact on your fund. So, you know, if you were, say, an early investor in Uber, you know, maybe you could sell 10% of your stake in the company. So you still hold 90% of your Uber upside and you could return 3x your fund. No one's going to fault you for doing that. You're still holding all the upside. You return a bunch of cash to your LPs. Everyone's happy. So I think when you have an outsized success like that, it can make sense to trim, but otherwise wait until this thing is public.
So is it, when it's at Series B funding, is it still VC or is it private equity now?
I consider it. I consider it VC all the way through to public. Basically, what you'll see happen is you have like angels and friends and family at the very early stage. Then you have VC funds, and the VC funds now they've raised growth funds. So Andreessen has a growth fund, Sequoia has a growth fund. They'll go all the way through multi-billion-dollar valuations, and that's considered late stage VC. And the thing that's really important now is markets are so much bigger. So companies many years ago, if they got to $1 billion, you know, in size or scale, that's considered very significant. Now everyone has a phone, everyone around the world's connected. It's like extremely large market opportunities. So you could still even generate venture-like returns investing in some of these later companies. Right before the companies go public, sometimes they'll raise from like a crossover fund or a public market investor like a Fidelity. That's when I think it starts kind of entering the more public market sphere.
Now, Hassan, same question goes to you. Do you believe that Series B funding is considered as a private equity acquisition, or is it still VC? Coming from a private equity background, I just want to see the contrast between the two views.
But Faisal, actually what I can define is from my language, from my point of view. The major difference between venture capital and private equity starts with the proof of concept. So it depends on when and at which point you identify the proof of concept. Is it the IPO? Is it the company making profitability? Is it the company achieving several milestones? It depends from investment thesis to investment thesis. But from my perspective, venture capital, private equity segregation, and by the way, nowadays it's becoming much more converged. So they are together. So some of the second, B stage, C stage, early stage venture capital versus private equity interfere with each other because it used to be the capital size. It's no more the capital size because capital is so abundant, it's so available. So it's more like a strategy. For example, even in the venture capital, and that's the good point to touch upon maybe, Faisal, is there are very important segmentation that Jake also touched upon, which is early stage, growth, and late stage. Now, the differentiation between late stage and early stage of VC is as different as VC versus private equity. So these asset classes are becoming so much different from each other from a perspective. That's why when we talk about
how are they different? Maybe you can shed a little bit of light on that. How is private equity different than VC?
Let me put it in this perspective. A lot of the institutional investors, right, have VC under private equity, right? And this is a live case here. Who we're talking to and about VC in Kamco, the head of private equity, right? So VC is private equity. Okay, it's just Hassan articulated very well. You know, in your opinion, as an investor, as a group, when does it switch from venture, which is high risk, adventure, you don't know what's going to happen, you're taking a bigger bet, and then as the bet becomes more and more scientific or data, as Jake said, you know, like spearhead spreadsheet jockeys, right? And so the more you get into analyzable data, the more it becomes private equity, again, you know, the same asset class, but the earlier it is, and the less data I think there is, it's more of a venture capital because you're taking bets that are not data related, not financial related at least, you know, and we talk sometimes about some of the deals we've done, you know, like what are we betting on? Like on the founder that had a previous exit and all the investors that just gave them money. That's it. That's not private equity. This is a bet. This is more venture capital. That's how I look at the two different. But VC is part of private equity. It's just, you know, the alternative, the most alternative in venture in growth private equity investment.
I'd also add that I think
Yeah.
it depends on the nature of the business. VCs focus on technology businesses, and like every business around the world nowadays is trying to reframe themselves as a technology business, but that's mostly
Technology
just
is not focused on technology anymore, Jay. So
sorry.
Technology is no longer focused on technology anymore. So it's across industries. It's across sectors.
It's not though. That's true. Yes, everyone has technology, but most of that's a mirage. If you look at the businesses that VCs fund, they're targeting true software businesses, businesses that have network effects, very sticky, extremely high gross margin. Sometimes it doesn't manifest like that, but this is a very specific type of business. It's not like a staffing agency that's powered by technology that's operating on much lower gross margins. So when you look at these businesses, they have common playbooks, they have common patterns, and that's why these founders increasingly want to work with people who've done it before. So they're going to seek out the VCs for even these later stage financing rounds instead of the private equity firms, because the private equity firms don't have the right experience with these types of businesses. So I think that's part of what it comes down to, is like focusing, hey, what's the real nature of this business? Is this really, and we call it technology leverage. Does this business have technology leverage? There's a difference between like having a mobile app to make it better and something that's throwing off profits like Google. And then I think the other point when you think about VC and private equity, as Fahad said, is there still adventure involved? Venture capital should come from adventure capital. And often you get the best returns when you're taking a bit of an adventure. So the VCs are more inclined to take that risk. If you look at a Series B deal that might be considered private equity, it may be very repeatable processes and they may already be generating profits. VCs, sometimes, you know, they'll fund a company to a Series B before they've even launched a product when they're still in technology R&D. Those things are somewhat common.
Is there a set criteria that you look for? Now you've identified a couple: high gross margins is one of them. Technology focus. Is there a set criteria that you go by?
Yeah, it's not fully set, but one thing that I really drill in on is the idea of what technology leverage. So is this fundamentally a technology business? If you look at a company like Dollar Shave Club, subscription razor blade company, they had about $1 billion exit. That's not a technology company. It's an e-commerce company, direct to consumer. And you know, they might have great margins like a razor blade company, but it's really not technology at the core. So when I'm looking at a business, I'll say, what are they raising money for? And if their use of funds is anything other than like building or distributing technology, then it's probably not a technology company. So that's something I dig into a lot. Another really good one to look at is how many engineers do they have? If their headcount is like 70% engineers, it's probably a technology company. If 70% of the staff is not engineers, probably not a technology company. So I think that's a really good one to dig in on as well.
Maybe Fahad, Faisal, what we're saying is also very critical. Now technology is everywhere means what? Now technology is transforming everything, because transformation is a very key word in what we understand, how we understand and interpret technology. For example, when you talk about, I don't want to give the same example over and over, Uber. What is Uber? So one of the most oldest industries in the world, right? Ride-hailing. So what is Amazon for? So selling the books that you read in the home. So that's the hard material that you're selling, but you're buying. So it's merchandising. So from that side, transformation is happening in everywhere. What is fintech? Transforming the finance industry, which has been 10,000 years ago, finance was there, but now fintech is transforming. This is why we are talking about the C stage investing, financing. So finance is also being transformed. So healthcare, health tech. So what is health tech? So transforming the healthcare industry, which is one of the oldest industries in the world. But from that side, if you don't mind, I just want to add one more thing, which is also very critical, because we are not also making a very theoretical discussion about what is good and what is not. We are also trying to shape what could be the right strategy to enter to the Silicon Valley if you want to enter as well, because it's not waiting for you. So when we are talking about technology transformation, it doesn't mean that it knock the door opens and you find the best deal waiting for your money. No. So from that side, access is everything. But what is access? So by this means, I just want to utilize this segregation that we just made, which is early stage, development, and late stage, growth and late stage. So from their side, we are seeing as Kamco the early stage, one of the emerging importance area that to go through. Why? If we just open that slide, if you don't mind, on especially defining the emerging managers as clear champions, because we need to identify what are the important areas that we can look upon as well when we are looking for the Silicon Valley potential investment opportunities.
Right?
Yes.
Okay.
This green, gray, and the flashy green slide. So
yeah.
This slide, when it comes, it will show much more clearly, but it shows that since 2014, what is the most winning asset class? It's the early stage. Why? Because I think Jake and Fahad also touch upon this very well. So you know something, you know that you know doing something, which is doing bags. But when your bags are selling very good, you start to make the shoes as well. So when your shoes are selling very good, you start to jump into the perfume business as well. But you are losing your core. You are losing what are you doing best. And from that side, the core, the strategy of the core funds that you initiated with the initial idea of doing what you do best is the most important strategy that we know is the emerging managers. So from this side, as we can clearly see from the slide that you're showing, emerging managers are clear winners and it provides you a best strategy. Why? Because finding an emerging manager is something else. And finding an investment opportunity directly is another thing. Because the best outcome of utilizing your relationship with emerging managers is A, you are getting a great bonding out of a universe like Jake's, founders, initiative, energetic, visionary, having a mission for the future, so they can rainmakers. So they are basically rainmakers who can change, who can transform industries, who can bring capital out there. But by also investing in these early managers, you are having a chance of filtering an opportunity of potential direct investments as well, which you have no chance before. So when you walk down from the Silicon Valley, there is no pitch books left and right. Here is company A, here is company B. It's a difficult task. But through direct investment in emerging managers, especially in the Silicon Valley, which is a valid 70 years old industry as well, with all the infrastructure for venture capital, when you have an access to the right emerging manager universe, it also provides you an access to the direct deals that they are investing. And it's very critical that, these direct deals are already past their selection criteria. They already invested in this asset class. So they're developing the asset class. You are following the asset performance. You are following the asset performance, which is done by your trusted investor. And as an investor, you are also doing your checks and balances. So what we are coming back to the original question that you asked, Fuad, every step that you are taking is reducing your risk and increasing the multiplier of return that you're going to make.
On the subject of capital raising, and maybe we can go to the next slide, Mohammed. Fahad, I know you personally. I know your track record in terms of your investments. I know you've successfully returned north of 33% in terms of IRR to your investors, and that's quite remarkable. But maybe you can explain to us what further than performance is is something that you can convince regional investors to explore the asset class. How have you successfully advised and convinced regional investors or local investors to invest so far away, to invest in a virtually untouchable or an unknown asset class? How have you successfully done that?
Yeah, sure. I don't need that slide. But so to answer that question, look, let me go back to actually, one of the slides, it shows how institutional investors, the big graph that has two lines, green and a blue, and we just saw it earlier. Yeah. It might be there, it might not be there, I'm not sure. But no,
slide number 3.
Yeah, so maybe we can start with that and explain your excellent questions about regional investors and the struggle they have with investing in this asset class, because it's, it's a greatly misunderstood.
I have data. Like for me, when I make an investment with a fund manager, I have data. I have track records. The companies that they invest in are generally anywhere from 10, 15 years to over 100 years old. So there is data on what I am deploying to. But the critical question that is how is it that you develop that picture for regional investors to get their confidence?
Well, I'll tell you what. First of all, regional investors are different categories, right? So if we look at the sovereign wealth funds, they've been in VC for decades, whether
Right.
it's KIA, they've been leaders in investing. They're in early stage, well, what they consider early stage is growth. So they're in growth stage deals, they're in late stage deals, they do a lot of pre-IPO. And then when the companies go public, they actually hold, right? And the KIA is one of the largest investors in Google and Apple, right? So they've been exposed to VC for decades. If you look at investment companies, and that's not just in Kuwait, Mubadala has done a great job, um, and Bahrain, Oman, Qatar, they all set up VC funds on a sovereign wealth fund level, right? And they're very active. Some of them have a fund of funds program. Some of them have, so there's different types of institutional investors have been approaching VC differently, but they've been very active in the GCC. So now the Gulf investors, family offices and investment companies want to follow the sovereign wealth funds because of the exits they've seen them realize and the growth they've seen them have on their investments. And now they follow the lead of these sovereign wealth funds. So institutional investors in general, that slide, is the slide still up there? Yeah, that slide shows us that since 2003 till 2019, the green line, which is the top decile mean, this is the average of the best investors, right? They have now over up to 15 or 16% of their portfolio allocated to the VC. So people say it's risky. Well, no, it's not. They think people put 1% in VC. The real big investment ballers, they put 16% in VC. Yale University Endowment, one of the best institutional investors in the world, has 20% in VC, right? You know why it's the best institutional investor in the world? Because it has 20% in VC. And because it knows which managers to invest with. As Hassan was saying earlier, and as Jake was saying, it's the network of the managers you work with. We if you remember, Faisal, we when you were in Global, I came with a few investors for you to meet, and we were working on fundraising for different projects. But I would bring them over to meet you in Global. Whether you've met Jake before, you met Joe Lonsdale before, right? You've seen Reid Hoffman. So we take the time to bring these amazing investors to meet the institutional investors in Kuwait and in other parts of the GCC. Now, family offices are realizing that, and now they're becoming more and more aware of how important it is to invest in this asset class. Because there's four things we were saying here today. We're saying why VC, it's the best asset class. Why now? Because of all the exits that have been happening, and because over 10 years it's been the best asset class in terms of performance. Why Silicon Valley? Jake articulated very well, the difference. And we mentioned how, the ecosystem is just the most mature, and the most R&D invested in the world is still in Silicon Valley in tech. Lastly, why, who's doing this? The best investors in the world. And so I think the clearest thing to do now is why we have this webinar. And, because everyone is clearly been asking for more information and more data points to understand this very misunderstood asset class, which I think still carries stigma. And, from the 90s burnout where people invested wrongly and didn't do their research properly. However, if you did invest properly in the 90s, if you know what you were doing, you'd be in Amazon, you'd be in PayPal, you'd be in eBay, you'd be in Expedia, you'll be in a lot of winners. Even after the 2001, if you invested then, you'd be in Google, you'd be in Facebook. If you invested in after the global financial crisis, the GFC, 2008, 9, 10, if you're writing checks, you'll be in Uber, Twitter, Instagram, WhatsApp, Pinterest, Airbnb, right? And so every time there's a problem, there's the winners come out of venture capital. And the risk gets lower, the rewards get higher. And today, after the pandemic, we realized how important it is for fintech, education tech, last mile delivery, e-commerce, marketplaces, all these, we couldn't live without them, right? And so I think everyone wants to invest in VC. They just want to know how to do it. And I've been spending time with the institutional investors because they know what they want. They have their parameters and they have budgets. Family offices tend to be a bit, you know, sometimes there's, the token family office
On the edge,
member who just came,
decisions.
who just came from America, who loves tech, or because, he started an app because he got, or the grandpa all of a sudden sees his kids on Snapchat and Roblox all the time. He's like, I want to invest in that. So these things are happening today. And of course, with the exits that are realized, I like Silicon Valley, clearly. You gave an example of Anghami. Anghami went public via SPAC, right? I shared Jake's sentiments on SPACs. But they went public on SPAC, right? If you look at that same week, Tidal, which is the Jay-Z app, which was supposed to be for like, rap and black artists to do their releases on this thing, like Drake and Kanye said they're gonna do it, and it's flopped completely. Tidal, right? It was sold for more money than Anghami, and Anghami has what was it, like 70 million registered users, right? And Tidal has like 0 maybe, right? But because that's a US company over there, it gets bought because of the brand, right? And Anghami has to go through a SPAC 13 years later and then have a nice exit. But I prefer Silicon Valley for now, and there's a lot of business happening. And if there's a bubble right now, if there's high frothy valuations in the IPO market, or everything, even copper is at the highest price ever, right? Even copper, right? So copper, because supposedly it's used a lot in the Tesla vehicles and electronic vehicles, they need a lot of copper. That's why copper is in high demand.
Copper's in everything. It's in your walls, it's under your desk, it's in everything.
Yeah, but it's never been this expensive ever. And it's been around for like 4,000 years. So everything is high right now, everything, but we like to invest in the early stage.
That's a good subject on valuation. I think you're touching up on a very important subject. If I recall the discussions I had with you about 3 years ago, Jake, it was regarding this subject. So we're looking at high valuations in the listed equity markets, right? So this is very evident. It's a new phenomenon. It's on the back of whatever you call it, global central banks pumping liquidity into the economy. Whatever it is, the valuations are at historical highs. And from my understanding, that the valuations of VC candidates is also on the rise or higher than historical norms. Maybe you could shed a little bit of light on that. Fahad or Jake, I think that this is a very interesting topic.
Valuations are certainly increasing, but you need to look at the market at different stages. So
is it discouraging?
Sorry?
Is it discouraging, the current valuations?
No, it's not. So the place that I focus is the early stage. And the early stage valuations, it's harder to move because, back to the body analogy, this is the capillaries. It's just hard to pump blood, AKA money, through there. There's just limited capacity for these deals. And it's really an artisan's craft, more of something that a hedge fund could get involved in and just throw money at. So the early stage valuations have not moved as much. So it even makes me more excited because you have early stage valuations at the earliest rounds that haven't moved incredibly, whereas the late stage and the growth in the publics have all gone up. There's a great tweet from one of my colleagues and Nivi, and the tweet was something like, if you're wondering whether valuations or returns are increasing faster, look at what the VCs are doing. And he's specifically referring to the early stage VCs, and they're now flush with liquidity because they had great exits. They are trying to push that back into early stage venture as fast as possible because they're so excited about the asset class. As you look at the later stages of VC, now it starts to move more in lockstep with the public markets. During COVID, there was actually a little interesting disparity where the publics, once they started to shoot up, the venture kind of stayed the same even at the late stage. So there was a good little arbitrage that you could get there. But you're going to see the closer you get to the publics, the more it moves in lockstep with that. But the early stage is uncorrelated.
Now, I know we're running out of time, but there's a few interesting topics that I really want you to shed some light on. So, cryptocurrencies versus blockchain. Is that a part of your targets as well? Maybe you could shed a light on the differences between approaching each or both.
Yes. So I am very interested in the crypto space. I've been holding Bitcoin since 2013 and have been following, been trying to convince Fahad to buy along the way, but that's that's a longer story.
Did you pay your capital gains tax on that, or?
I don't sell, so there's no capital gains to declare. I'm buy and hold. I think it's incredibly interesting when I work with founders, and especially some founders who have been successful. They want to like invest very aggressively back into venture. I tell them put 80% of your money into early stage venture and 20% into crypto. This is not financial advice. Families probably would want to do something different. This is for people who want to have a lot of risk in their portfolio. But I think Bitcoin is very significant. It's digital gold. I think it's going to be valuable. And some of the early things happening in the DeFi space are really interesting. Most of that's built on top of Ethereum. The scale and volume that happens with these is absolutely mind-boggling. It's not at the level yet where, say, it's useful for large global institutions, but it's already getting adopted by the cryptocurrency community. They're DeFi, I'll just explain it briefly, but it's called decentralized finance. So in the way you may go to Goldman Sachs and say, hey, can you sell me this swap or this derivatives, or I want to do this thing? There are people who are building these contracts in a trustless way on the blockchain. So you can transact peer-to-peer with no intermediary involved. I haven't compared it to, say, Goldman or whoever and see who gives me a better rate, but there are tens of billions of dollars now flowing through this space. And the returns to the VCs who are involved it's incredible. You know, if you were a seed round investor in Uber, you're looking at like a 3,000 plus X return, but that takes 10 years. If you were like a seed investor in the right companies in DeFi, you're looking at like 1,000X plus in a year. So the people who are knowledgeable about this are looking at it very closely. Of course, crypto is a little bit of the Wild West. There's a ton of risk. And just like you need networks in Silicon Valley to do well in early stage venture capital investment, you need to have a bunch of technical acumen and connections to make sure that you do well in crypto. But it's incredibly interesting space overall.
Now, in the interest of time, I know we're running out of time. Hassan, I got one last question for you. Again, I'm biased because you're a fellow colleague and you represent Kamco. What is Kamco doing in the VC space? What are some of the initiatives that you imagine might be in the coming future, very near future?
Yes, and thank you, Faisal. And this is a very important question for us as well. So from that side, let's first summarize what are we talking about here. We are talking about, as Kamco, we are one of the most prominent financial institutions, especially on the alternative investment and non-banking finance as well. So from that side, closing our eyes to any of this discussion topics that we are talking and negligence on that investment areas is a big mistake that we can do. So we are very closely following what's happening in all of these industries. We already invested some minor amounts in the local venture capital area to understand the market better. But as of today, as we discussed very closely, we are seeing one thing. Diversification is very important for the investors in GCC, and return profile and returns that we are seeing recently with our recent connections that's happening around is very promising in the venture capital area and the Silicon Valley as well. So this is definitely an area that we identified that we want to bring a product which connects the GCC investors to the opportunities from Silicon Valley. What segment of it? Definitely early stage, because you know the early stage is an area, as we discussed throughout all this webinar, that we should not be missing for two reasons. One, we need to choose the right investors to be in the beginning of this new cycle, and two, we want to also invest in the portfolio companies of these new investors, and we want to be a part of that community. So as Kamco, we are not seeing that let's have to make one product and let it be the final product. And no, we want to be a permanent resident of the Silicon Valley. So we want to be a part of that community. We want to have this great relations like Jake, like Fahad, and we want to have entrepreneurship. We want to have partnerships with all these valuable people to have. And we also know what the GCC investors want. We also know what are the critical decision points that the GCC investors are looking forward to with diversification. So from that part, definitely we are at the phase of structuring a product that will cater all these demands together. And by the way, we're gonna do it with the very valuable partnerships and insights from the Silicon Valley. But as I want to underline one thing, we want to become a permanent resident of the Silicon Valley, and definitely we will be coming with multiple products to start with our debut product very soon, inshallah.
Awesome. Excellent. I think we've used up our time for this evening. So I think in conclusion, I would like to thank all the panelists and attendees for taking the time to make this webinar happen. It is also a true testament to the subject, as we are all gathered in one place through mechanisms and technology that enable us to transcend borders and time zones. At Kamco Invest, it is our duty to provide access to the best of breed opportunities in asset classes such as VC and others. We always share the approach of seasoned and successful industry professionals that have already demonstrated a successful track record in mastering management of assets in the respective asset class. We are also confident that these managers will continue to navigate the challenging markets ahead through their disciplined approach that has been tried and tested during the challenging markets of the past. As always, if you're interested in receiving the material used in this webinar and or receive a report that was prepared by our team titled Venture Capital, a key component in wealth creation investment strategies, please feel free to reach out to our marketing team at Kamco Invest. Thank you all and have a good night. And for the panelists, thank you for your time. Jake, thank you for joining us so early in the morning, and for the gentlemen and the team here in Kuwait so late in the evening. And for all the attendees, thank you very much.
It's a pleasure.
Thank you.
Thank you.
Thank you, Faisal.
Thank you, guys.
Thank you.
Have a good evening, everyone.
You too.
Have a good evening.